Welcome to Alpha Insights. I'm Kristen, and today we're breaking down a bold move in the cannabis industry. I'm joined by Jessica, who helps make sense of the numbers and the risks. Remember, if you have questions as we go, you can ask us at stockalpha.ai.
Thanks for having me, Kristen. Excited to walk through this one. It's a textbook high-risk, high-reward corporate bet.
Okay, let's get right to it. In plain terms, what's the deal?
Organigram bought a Berlin-based company called Sanity Group. Up front, they paid about 107.3 million euros, roughly 78 million euros in cash, and 29.3 million euros in Organigram stock. And there are earnouts that could bring the total to around 250 million euros if Sanity hits aggressive targets.
So they basically put most of their cash and credit on the table for Germany. Why Germany specifically?
Germany is the largest federally legal medical cannabis market in the world. Policy changes in 2024 reclassified medical cannabis and opened big distribution and prescription channels. Sanity pivoted into that medical market and scaled fast. That's what made it attractive.
Walk me through how Sanity went from a money burner to this attractive asset.
They spent a lot early on. About $109 million in venture funding over several rounds, building brands, distribution, and infrastructure for a recreational market that didn't fully arrive. Revenue in 2023 was only 9 million euros, with low margins. Then the regulatory change happened. They pivoted into medical distribution, and revenue jumped to about 60 million euros in 2025, while gross margin expanded to about 47%, and EBITDA turned positive.
Wow, so the turnaround pretty much happened before the acquisition.
Exactly. Organigram bought the post-pivot business, the distribution network, logistics near Frankfurt, a pharmacy network, and plans to expand elsewhere in Europe.
You mentioned earnouts. How do those work here?
Good question. To collect the full additional amount, Sanity needs to deliver 143 million euros in net revenue and 20 million euros of positive EBITDA in the 12 months ending in April 2027. Also, it must be cash flow self-sustaining for any earnout to pay. So Organigram pays most of the price only if Sanity keeps compounding quickly.
That structure sounds smart. It limits the upfront risk. But Organigram still used a ton of capital, right?
Yes. Organigram entered the deal with about 54.8 million Canadian dollars in total cash, deployed most of it, drew on the last of a strategic investment pool funded by British American Tobacco, took a 60 million Canadian dollar credit facility, and issued about 65.2 million Canadian dollars of equity to British American Tobacco. Their balance sheet is much thinner and now carries debt.
So that's one big risk. What are the others?
There are several. One is regulatory. German policymakers are actively debating restrictions on telehealth prescriptions and mail-order flower, the exact channels helping Sanity grow. A clampdown would hurt revenue and could wipe out the earnout. Second is valuation. Organigram paid a higher revenue multiple than some recent German deals, so this relies on continued compounding. Third is execution risk. Rapid growth can be hard to sustain across more markets and channels.
And British American Tobacco, they were involved before, right?
Yes. BAT led a prior financing for Sanity and now owns about 30% of Organigram. BAT chose to take Organigram shares in the transaction, so they're financially aligned on both sides.
How does this move compare to what other Canadian cannabis companies are doing?
Different strategies. One competitor is funding Europe and medical expansion from operations without new debt. Another repaired its balance sheet with a recapitalization and now sits with net cash but still has operating losses. A third has a big gross war chest but also large debt and is diversifying outside pure cannabis. Organigram stands out because it concentrated one market, one acquisition, most of the cash. Right.
Given all that, what's the practical takeaway for listeners who want to understand the implications but not looking for investment advice?
Sure. And quick disclaimer, this is for informational purposes only, not personalized advice. Analysts note that this is a concentrated bet on Germany's medical market. Data suggests there's clear upside if the market and current distribution channels hold. Momentum indicates that Sanity has already proven a pivot and scale. On the flip side, regulatory change or execution missteps could dramatically change the outcome because Organigram is now more levered and has less cushion.
Interesting. So it could be a home run, or it could be a very painful lesson in concentration.
Exactly. The next 4 quarters of the earnout period are critical. They'll tell us whether this was strategic foresight or too much conviction too soon.
Interesting.
Yeah, that's a good point.
Okay, Jessica, let's wrap with the top takeaways for listeners.
First, Organigram made a concentrated, high-risk, high-reward bet on Germany by buying Sanity and funding most of it with cash, debt, and equity to a strategic partner. Second, Sanity has already shown dramatic improvement after pivoting to medical distribution. Revenue and margins improved rapidly. But the earnout requires the business to more than double in a year. Third, the biggest risks are German regulatory changes, the aggressive earnout targets, and a thinner balance sheet for Organigram.
Great summary. And a final reminder, if you have questions about anything we discussed today, you can ask us directly at stockalpha.ai. We answer listener questions live. And for more market insights, head over to stockalpha.ai.